Imagine this. Someone passes away, and their family expects a $500,000 life insurance payout. But weeks go by, then months, and suddenly the insurance company says something shocking. We can't pay the beneficiary. Not because the policy didn't exist, but because the beneficiary form was wrong. This happens far more often than people think. Today I'll show you exactly how life insurance payouts work, who actually receives the money, and the 3 beneficiary mistakes that can cost families hundreds of thousands of dollars. At its core, life insurance is simple. You pay a monthly premium, and if you pass away, the insurance company pays a lump sum of money to someone you choose. That person is called a beneficiary. Think of it as a financial safety net for the people who depend on you. The payout, called the death benefit, can be used for anything. It can help pay off a mortgage. It can cover daily living expenses. It can fund college tuition. And it can replace lost income. And here's something many people don't realize. Life insurance payouts are usually tax-free. That means if the policy pays $500,000, the beneficiary typically receives the full $500,000. No income tax, no deductions. But who actually gets that money? That's where beneficiaries come in. A beneficiary is simply the person or people who receive the life insurance payout. You choose them when you buy the policy. Common beneficiaries include spouses, children, parents, and sometimes even business partners. But you can actually name almost anyone. You could name a charity. You could name a trust. You could even name multiple people at once. For example, a policy might say 50% goes to a spouse, 25% goes to child number 1, and 25% goes to child number 2. When the policyholder dies, the insurance company splits the money exactly that way. And here's the key rule. The beneficiary designation overrides almost everything, even a will. That means if your will says one thing but the insurance policy says another, the beneficiary form wins. This is why updating beneficiaries is extremely important. There are actually 2 types of beneficiaries. The first type is called primary beneficiaries. These are the people who receive the money first. For example, the primary beneficiary might be a spouse. But what if the primary beneficiary is no longer alive? That's where the second type comes in. These are called contingent beneficiaries. Contingent beneficiaries are the backup recipients. For example, the primary beneficiary might be the spouse, and the contingent beneficiaries might be the children. If the spouse has already passed away, the payout automatically goes to the children. Without a contingent beneficiary, the payout can get stuck in probate court, which can delay the money for months, sometimes even years. Once the policyholder passes away, the process begins. Here's what usually happens step by step. First, the beneficiary contacts the insurance company. Second, they submit a death certificate. Third, they complete a claim form. Once everything is verified, the insurer processes the claim. For most policies, the payout happens surprisingly fast, often within 30 to 60 days. And once the claim is approved, beneficiaries can choose how they receive the money. One common option is a lump sum. This is the most common choice. The entire death benefit is paid immediately. Another option is installments, where the beneficiary receives monthly or annual payments over time. A third option is called a retained asset account. In this case, the insurer holds the money and pays interest while the beneficiary withdraws funds when needed. Most financial advisors recommend the lump sum option because it gives the family full control of the money. Now, here's where things get serious. There are 3 extremely common mistakes that cause life insurance payouts to go wrong. The first mistake is not updating beneficiaries. Imagine this scenario. Someone names their spouse as the beneficiary. Years later, they get divorced. But they never update the policy. When they pass away, the insurance company still pays the ex-spouse, not the current partner, not the children. Because legally, the beneficiary form controls the payout. This happens more often than you'd think. Major life events should always trigger a beneficiary update. Events like marriage, divorce, the birth of a child, or the death of a beneficiary. The second mistake is naming a minor child directly. Many parents list their young children as beneficiaries, but this creates a huge problem. Insurance companies cannot legally pay large sums directly to minors. So the money often gets locked in court-appointed guardianship. That means legal delays, court supervision, and extra costs. The better option is to name a trust or custodian to manage the funds until the child becomes an adult. The third mistake is having no contingent beneficiary. If the primary beneficiary has already passed away and there's no backup, the payout goes to the policyholder's estate. That means probate court. And probate can take months, sometimes even years. During that time, the family might struggle financially, even though the insurance money exists. A simple contingent beneficiary can prevent all of this. While life insurance payouts are usually straightforward, there are a few situations where claims can be denied. The most common reason involves something called the contestability period. For the first 2 years after buying a policy, the insurer can investigate misstatements on the application. For example, undisclosed medical conditions, smoking history, or dangerous activities. Another clause is the suicide clause, which typically applies during the first 2 years. But after these periods pass, claims are rarely denied. In fact, the vast majority of life insurance policies pay exactly as promised. Life insurance isn't really about money. It's about what happens to the people you care about when you're gone. A well-structured beneficiary setup ensures that families receive support quickly, children are financially protected, and assets avoid probate delays. But a poorly set up beneficiary designation can cause confusion, disputes, and long legal battles. Which is why experts recommend reviewing beneficiaries at least once a year. Life insurance is one of the few financial tools that can instantly create wealth for a family during the worst moment of their lives. But only if the payout goes to the right person. So here's a simple question. If something happened to you today, would your life insurance money go exactly where you want it to? Because for millions of people, the answer is no.